Aarati Krishnan and you're watching A to Z of stock market investing. Today let's look at S for surprise, as in earning surprise. In real life, surprises are always positive. So if your best buddies throw a midnight party on your birthday, it's a surprise. If they forget all about your birthday, it's a nasty shock, right? But in the stock markets, you will hear both positive surprises and negative surprises mentioned. What do these terms mean? Recently in July, Sun Pharma gave a nasty jolt to its investors by announcing a profit warning for the current year. Its stock tanked 15% on a single day after the company said that its revenues and profits could both be lower this year than in the previous year. It basically said that after acquiring Ranbaxy earlier this year, the cost of the acquisition could depress its profits. This came as a negative surprise to its investors. A negative surprise in stock market parlance is used to denote an event or an announcement from the company which actually reduces the profit expectations from the company. As we saw in the video on PE ratio, basically investors in the stock market assign a price to the stock based on the rate at which they expect its profits to grow. This is what determines a stock's PE. So if a company suddenly comes out with new information which tells investors that the profit growth may not be as high as they expect, then the PE ratio can get derated. This is what constitutes a negative surprise. Having delivered this negative surprise to investors in July, what Sun Pharma actually did was in August it declared its profit numbers. Its profits were down 65% year on year and its revenues were up marginally. But the stock price actually went up on the day of the results. This was because, having already prepared investors for poor performance earlier, Sun Pharma was able to avoid a negative surprise on its results announcement. So this is the potential that surprises have to move the stock prices in the market. Laymen watching the stock markets from day to day are often puzzled by the crazy movements that stock prices have on days when companies announce results. For example, a year ago, Infosys had this long losing streak that whenever it would come out with its quarterly results, investors would be disappointed and would mark down the stock. On occasions, the stock would even fall 10% or more. Now, this was mainly because of negative surprises. So, investors had a certain expectation from Infosys for profit growth, and when its results didn't turn out to be as good or the management guided for a lower result, then investors got disappointed with its performance. The tables have turned in the recent quarter though. Infosys reported a 4.5% dip in its sequential profits in the recent quarter, but the stock was actually up. So investors think that when stock prices gyrate madly on the results dates, it's a sign of irrationality in the stock markets. That's not really true. The truth is that a stock like Infosys is tracked by a large number of analysts who make profit projections on how it may grow in a particular quarter. When the company comes out with its actual results, the only comparison they make is whether the profits that it has announced is in line with the profits that they had projected for the company. If they are out of whack, then the stock prices react accordingly. If the profits that are declared are completely in line with the projections, then the stock may not react at all. This is in fact why sometimes you find that companies which declare huge profit growth may not see any reaction at all in the stock market. Similarly, companies which declare losses or have seen profit falls can sometimes go up. This is because investors would have expected much worse and the results would have surprised them. For companies looking to avoid nasty falls in their stock prices on results day, understanding this concept of surprises is very important. Basically, if they expect to perform badly, it is good to hint about it to the stock markets much in advance of the event. By doing this, they will be able to manage expectations and make sure that the stock prices do not nosedive if the results are not as good as people were expecting earlier. There is a good lesson here in fact for the government too. If political parties actually kept their manifestos very short and didn't make wild promises in them, actually when they come to power, even if they don't deliver all that much and they manage only a few good moves, the markets would be quite happy with it. It's all in actually surprising the markets.